On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. Before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope everyone is well. Let's talk about last week across financial markets, then let's turn our attention to the week ahead. Starting with global equity markets, and the S&P 500 index in the US had a very good week. We saw it rebound 3.7%, so it's recovered a lot of that weakness we've seen of late, and that was actually the strongest weekly gain since May. That actually saw it edge just back into positive territory for November. We've closed off the month of November 2 now, and that very marginal gain of 0.1% is still a gain, so that represents the 7th month in a row that the US market has risen. Other markets followed suit last week. We saw the FTSE 100 in the UK up 1.9%, key indices in Europe, Japan and emerging markets up about 2.5%. The Aussie market was up 2.3%, while the local NZX 50 ended the week 0.5% higher. So a bit more subdued here in New Zealand, but when you were seeing a bit of volatility elsewhere, we were holding up better than most. So I think that's why our rebound was a little bit more subdued. Shares in New Zealand and Australia both finished November lower in contrast to the US. So the local market posted its first decline since April for the month. That comes on the back of 6 consecutive monthly gains, while the Aussie market was down quite a bit. It was down 3%, so that was the worst month that we've seen in 8. So definitely a mixed bag out there when you look at the month of November. Interest rates, the New Zealand 5-year swap rate increased 23 basis points over the week. That's quite a lot actually. That came in the wake of that last RBNZ decision of 2025. We'll get to that soon, and that saw the 5-year swap rate finish the week at a more than 3-month high of 3.4%. We also saw the Kiwi dollar rise strongly against most trading partners. So it finished the week up about 2% against the US dollar, a little above 57 cents. It was also quite strong against the Japanese yen, up 2%, up more than 1% against the pound and the euro, up slightly against the Aussie dollar, but we're still sitting at about 87.5 cents against the Aussie. So we're still quite low against the Australian dollar compared to where we have been in recent times. Right, looking back over some of last week's key events, and here in New Zealand it was all about the Reserve Bank. So we did see them reduce the official cash rate by 0.25%. That was fully expected by everybody, markets and economists. That sees the OCR at 2.25%. That's the lowest since 2022, and it's down from a 15-year high of 5.5% in 2024. So that cut was expected, and it was all about the commentary and the forecasts. And in that regard, the OCR track in the forecast pack bottoms out at 2.20%. So that does leave the door ajar for another cut if needed. However, it does also suggest that the Reserve Bank sees this current level as the most likely bottom. So in the wake of that release and in the commentary, we saw wholesale interest rates rise and the New Zealand dollar strengthen quite a bit. And the reason for that is that while we got the OCR cut like we expected, markets were already pricing that in, and they were pricing in a pretty decent chance of another cut next year. And the Reserve Bank sort of poured a bit of cold water on that, and markets are now rethinking whether there's much chance of another cut next year. And the general tone is we're probably at the bottom. So maybe a cut next year is quite unlikely. So if you've got a mortgage that's due for refixing, then it's a good time to talk to your mortgage broker or your investment advisor. Have a think about that, because while there could be a bit more downside to mortgage rates as banks compete for market share, we're probably pretty close to the bottom in terms of that fundamental interest rate cycle. So we're getting pretty close to that as good as it gets period, and maybe locking in that 2-year rate or that 3-year rate is not unwise right now. But talk to an advisor or someone who knows what they're doing. Another piece of information we got last week that was really interesting was business confidence. And this really did play into that thinking that the OCR cuts are behind us. The ANZ Business Outlook survey for November reflected a sharply more optimistic tone. Headline confidence rose to 67.3 and own activity jumped to 53.1. So these were both the highest we've seen since March 2014, right? That's 11 years ago. John Key was still Prime Minister back then. Obama was still in the White House in the Oval Office. It's a long time ago. Past own activity surged as well. That hit the highest level since 2021. And that's really important because that suggests that the optimism we're seeing is not only due to hopes about the future, but it's also being driven by a genuine improvement in conditions and activity. So that better mood looked to be quite consistent across the board, but ANZ did note that the manufacturing sector in particular had seen a much bigger uplift than people were expecting. So when you look at this and when you also combine it with something else that came out last week, on the same day actually, the September quarter retail sales report, which was also very strong, it starts to look very likely that that OCR cut from last week was the last one this cycle. I think they're done. I think that is the bottom. So not a bad thing. That's what we want, because we want the economy to be looking better. We want to see some improvements on the horizon. We don't want to be cutting interest rates because the economy is getting increasingly worse. We want it to stabilise and rebound, and it looks like that's happening, and that's certainly corroborated by some of the anecdotal evidence out there. Most of the businesses I talk to, there's always winners and losers. There's always pockets of strength and weakness. But generally, the businesses out there that I talk to, big and small, are seeing genuine gains across the board. I don't know if you guys can hear that background noise. I got a house full of kids. We had junior cricket this morning. Half the team seems to have come back to my house. They had a big win, so I've got a house full of boys that are all pumped because they posted some really strong scores today, so just bear with me. Looking out to this week, and it will be another busy week in the US. We will have the November ISM indices on Monday and Wednesday. We will have the December University of Michigan survey, and we will have the delayed PCE inflation report for September. Now, these will all come ahead of next week's Federal Reserve meeting, where markets see an almost 90% likelihood of a 0.25% rate cut. Now, it was only just a few weeks ago where markets saw a rate cut as quite unlikely, but the odds have really moved, and they've jumped from 40% to about 90%, and I think that is a big part of the improved mood across financial markets. It is that hope that we will see the Federal Reserve keep on cutting interest rates. So I think that is on the 10th of December in the US. So it'll be Thursday morning next week, New Zealand time. So a couple of things to watch in the US. Across the Tasman, we'll get the September quarter GDP report. This is out at 1:30 p.m. New Zealand time on Wednesday. This will be an interesting one because we got some inflation figures last week out of Australia, and the annual inflation rate for October jumped to 3.8%. Now, that was above forecasts, and it's the highest we've seen since June 2024, so almost 18 months ago. And you put that together with some of the other robust economic indicators out there, from Australia that is, and that has seen expectations for any further rate cuts anytime soon really dry up. So a solid GDP report would at least provide us with some comfort that while you've got more stubborn inflation, while the RBA is probably going to be on the sidelines for as far as the eye can see, at least you've got a strong economic backdrop. It's okay to have higher inflation and higher interest rates if you've got a strong economy. Then at least you've got the good with the bad. The real problems come when you've got a soft economy, but you've got high inflation. That's what puts central banks in a bind, and that is a very ugly combination for markets. So with a bit of luck, we'll see some solid numbers out of Australia. Here in New Zealand, we will have a dairy price auction early on Wednesday morning, and this will be interesting too because there really has been no reprieve for the ag sector of late. The headline Global Dairy Trade Index has fallen for 7 consecutive auctions. So a fortnight ago, prices were down 3%, and that headline index is now about 18% below where it got to in May. That was a 3-month high, and it's almost 10% lower year to date. So it's not all bad. It hasn't been because of weak demand, those price declines. The key reason has been robust milk production, both here in New Zealand and around the world. So that higher production, those stronger volumes, that's been weighing on prices. But what it has done is it's meant that Fonterra has had to cut its payout forecast, as we've been expecting and talking about this season. So before, they had a midpoint forecast of $10, and they've cut that to $9.50. So that's a decline of 5%. Now, $9.50 would still be pretty good. Last season, the farmers got $10.15, and that was a record high. Before that, the highest, I think, was $9.30 in 2021-2022. So at $9.50, it's still the second highest of all time, the best outside of last season. So I think that is just a natural easing in prices across the dairy sector. Also this week we will get building volumes for the third quarter. That will be important. That's out on Thursday. That will feed into the September quarter GDP report here in New Zealand, which is out sort of middle of December or thereabouts. The Aussie one's out this week. Ours is a little slower to come out, but that will be another key piece of data for that RBNZ picture. And when you look at the retail sales from last week, and if we get some solid numbers for building volumes this week, I think we will see quite a healthy rebound in quarterly GDP, which would obviously be good news. It means the recovery is starting to take hold and things are on track, but it would also firm up those expectations that we will see no more cuts in the OCR this cycle. So that will be interesting to watch too. On the corporate front, we've had a busy couple of weeks in New Zealand and things quieten down a little bit now. We have got a couple of AGMs, Scott Technology, Delegate, both holding AGMs this week. Across the Tasman, Bank of Queensland holding an AGM. There's a couple of companies to keep an eye out for internationally. Results from CrowdStrike on Tuesday. Dollar Tree, Macy's and Salesforce on Wednesday. Salesforce in particular will be worth watching. Dollar General and Hewlett Packard on Thursday. Those international ones, those are all US time, so we'll get those a day later. So Salesforce out on Wednesday, but that's Thursday in New Zealand time. So that's all for this week. Take care, everybody. Just one more month to go. Geez, this year's gone fast, hasn't it? So we're almost in that zone where we start hearing and thinking and talking about 2026 forecasts, expectations, and key themes. So, geez, I better put the thinking cap on, try and come up with something sensible to say to you all. All right, that's all for today. I need to go and wrangle this group of 10-year-old boys and try and get them under control in some shape or form. So thank you for listening. Enjoy your week, and we will talk again soon. Cheers.
For more insights, visit craigsip.com.